Hello, and welcome to the eighth episode of Raising Capital 101. I'm Tom Voekler, and I'm joined today by fellow members of our REIT, Capital Markets, and Securities team, Chip Cunningham and Kathy Lawrence. And we're going to be talking today about what an initial public offering or IPO is. Kathy, in simple terms, what's an IPO?
So in a nutshell, an IPO or initial public offering, first the process through which a privately owned company first offers its securities, which is typically common stock, for sale to the general public on a U.S. stock exchange. The process involves a team of external advisors to the company, legal counsel, auditors, and particularly the investment bankers who will actually take the company's stock to market.
Do you have anything more on that, or?
That's the nail on the head, probably to be distinguished just from a public offering, which you either have follow-ons after your IPO, again, issuances of stock in the market, or I know podcasts have discussed private offerings before. You certainly have a private offering that accidentally becomes a public offering, and that's a different regulatory issue.
Perfect. So, Chip, at what point does a company usually consider going public?
Yeah, so the question of why go public, there's a bunch of different reasons. Primarily, you think of raising capital as the primary reason, raise funds for business expansion, debt reduction, acquisitions. We do a lot in the real estate space, a lot of real estate acquisitions, but that could also be businesses, research and development, liquidity for the existing shareholders. An IPO can provide an opportunity for existing shareholders like the founders, maybe employees or seed capital to sell some of their shares and realize liquidity and hopefully profit. An IPO creates a public company that can use its stock as currency for acquisitions, M&A activity. You can also have employee compensation reasons. You can attract talent with a publicly traded common stock. You can have stock options and offer that as part of the incentive package. And then ultimately, as a public company, you'll have increased visibility in the marketplace that can attract new business partners, new opportunities, new customers.
Yeah, so it's like a double-edged sword. On the one hand, you want to be out in the public, it can attract opportunities, and on the other hand, it does bring a little bit of regulatory oversight, doesn't it?
It does.
Yeah.
And those are the downsides, certainly downsides to consider. There's the regulatory burden going from a private company that does have some regulatory burden and scrutiny with it to a public company that is reporting and subject to not only SEC requirements on reporting and corporate governance, but also the listing, whether that's NYSE, NASDAQ, or what have you. They also have their own requirements. It's a costly process, the significant expenses of your legal auditors, and then ultimately the underwriting fees if it's successful. And if it's not successful, those are costs that'll be eaten, and certainly talking in the millions of dollars. And then you're getting into a public stock that's going to have market volatility for reasons that have to do with other than what's happening at your company, just market trends, economic conditions that cause that to jump around.
And then I guess there's a lot of time value spent on being a public company, right?
Yeah, I mean, both in becoming a public company and then in being a public company, just the extensive regulatory requirements related to things like corporate governance, accounting and financial reporting, adherence to certain internal control standards, both establishing those on the company side and maintaining and reporting on those. Companies also, as Chip mentioned, subject to the listing requirements of the stock exchange, all of which involve both substantial expense as well as time, both in establishing and getting those things set up, as well as, ongoing reporting.
Yeah, so we talked about that a little bit in some of the private capital context where we said you got to change a little focus of what you've done on day to day and add a little bit of time towards capital raising. This sounds like, there is a pretty big demand on an organization and, maybe a ramp up of personnel that's needed to comply with a lot of this regulation. So I would envision, Chip, that's some of what you're talking about when you're talking about expense, right?
Certainly the time cost that's attendant to the ongoing public company issues and probably a need to expand your personnel by some measure to deal with those because they are time sensitive with deadlines, and failure to meet those deadlines can have some significant consequences. But you're also talking about in the IPO process itself, which can be 6 to 9 months out in terms of the initial planning to actual execution of the IPO. That is going to take a considerable amount of attention from the C-suite and managers, all of the personnel of the company involved in producing the financial statements and the marketing story for the underwriters, not to mention the eventual roadshow if things are successful that management will need to attend. So that needs to be taken into account.
Yeah, I was going to mention something about that as well, Chip, just in terms of timing of the process overall. I mean, really the initial kind of preparation stage that you're speaking to, just that stage alone can take anywhere from, I would say, 6 months to 2 years prior to the launch of the IPO, just depending on where the company is at the outset of the process, both in terms of building out the, again, internal systems, controls, and financial reporting for compliance with disclosure and meeting, shorter financial reporting deadlines, forecasting, and also just, as you touched on, establishing an appropriate corporate governance structure, setting up a board with independent directors and audit and other committees, necessary management restructuring, executive comp and incentive plans, getting those established, basically putting everything in place required to enable the company to satisfy the regulatory requirements that it will be subject to as a public company.
It definitely is going to be a lot of time spent on diligence, and I think that may be a concern for some people that aren't used to the scrutiny. They've been a private company, they've kind of done things their way, and now you guys are saying there's a lot of requirements and regulations. So I would think that's probably something you guys have experienced with clients. It's a new environment.
Absolutely. I would say, both at that point in the process and also, once the company has gone public, even to a greater extent. I mean, there'll be, obviously a public company is required to provide pretty extensive public disclosure of its general information, both financial and operational, which means that it's, both competitors and the public will have access to information that, previously considered confidential. So that tends to be an adjustment for companies that have taken the public route.
So just to add to what Kathy just said, certainly companies need to consider that as a private company, they were able to sort of operate behind the screen. But once you get into the IPO process, there will be a lot of sunlight on the financial health and stability of the company. And so as part of considering whether to go and do an IPO, a company needs to consider, is the company in a good place of financial health and stability? Or are there weaknesses? Because those weaknesses will come to light. The underwriters will, in their diligence, uncover them because they are trying to determine things that might be a risk to themselves as underwriters and also the company. And then, secondarily, if you're successful in the IPO process and become a public reporting company, then, at least on a quarterly basis, there will be short-term performance expectations where on a quarterly basis, the financial health of the company will be under scrutiny. And so management and related personnel need to be prepared for that sort of scrutiny.
Well, we've certainly talked about a parables of evils, right? We've talked about what the problems are, but, Kathy, what are some of the benefits of doing an IPO?
Sure. And I think, Chip has touched on some of them already, but, I think the primary benefit of an IPO is probably obviously the most obvious, as he's mentioned. It can enable a company to raise a substantial amount of capital relatively quickly and without taking on additional debt, which can then be used to, toward various company growth initiatives. Chip mentioned that, a benefit of being publicly traded is providing liquidity for founders and early investors, enabling them to trade their shares on the open market, which gives them a means of monetizing their investment in a way that's typically not possible for, with shares in a privately owned company. I think Chip spoke to the use of shares as currency for acquisitions, has the benefit of conserving cash while also facilitating deals in the future. Use of publicly traded stock as to offer equity-based incentives to employees, both current as a retention tool and attracting and retaining new employees. And then he also had mentioned that, the IPO can enhance a company's reputation and helping it to gain additional visibility and credibility in the market. I would say that those are the primary benefits looked at in considering an IPO.
Yeah, that's great. So it's a long, expensive process, but the capabilities of raising substantial cash and hopefully the capital cost, equals out at the end. It does seem like Chip, you mentioned a lot about financial wherewithal. It does seem like the IPO process is really geared toward a company that is at a growth phase where they are larger and can support some of these initial costs plus the ongoing like G&A costs. Is that a correct assumption?
Yeah, absolutely. And, what we have seen either doesn't have the size or sort of short-term growth to get to size with the IPO capital is that, a company can make it through the IPO process, but they become orphaned because they're not of a size to attract real trading activity, particularly in institutional sponsorship, which moves the stock. And so they get to a point where they can't grow because they can't really further access the markets for capital. They have these regulatory burdens that they've taken on, which are somewhat fixed and large in proportion to a small company. So that's a risk of completing the IPO and not being of size.
As you can tell, these two are experts on this, and I think that will wrap up today's discussion on some aspects of raising capital, and here, especially through an initial public offering. We thank you for joining us today. If you have any questions or suggestions for future episodes, please contact us. You can also visit our securities and corporate governance and REITs webpages at williamsmullen.com. There you can find out more about our team as well as all of our legal alerts. And finally, please be sure to subscribe to this podcast so you can be notified when our next episode posts. And thanks for listening. Until next time.